Good morning, and thanks for joining us for Tecnoglass's second quarter call. We're going to start with the takeaways for the quarter. It was the second highest revenue quarter in the history of the company, just second to the comparing quarter of Q2 of 2023 at approximately 220 million for this year. That was in large part driven by a record revenue quarter as far as the single-family residential segment goes, which was up an impressive 10% year over year, despite the challenges from a macro perspective in terms of high interest rates and mortgage rates. And even more impressively than that, we had record level of orders, which were up 60% year over year. Orders that were taken in Q2 that will be invoiced through the rest of the year, Q3 and Q4, paving the way for a pretty good second half of the year as far as the single-family residential segment goes. From a gross profit perspective, we were able to increase sequentially our gross profit margin by 200 basis points. That was driven by operating leverage on higher revenues. But when compared against the last quarter of 2023, the second quarter of 2023, we still had some headwinds related to FX, which I'll touch here in a little bit. And obviously, deleveraging on lower revenues and salary increases that took place at the beginning of this year. From a cash flow perspective, very strong cash flow, despite the fact that second quarter is typically or normally the lowest cash flow quarter of the year, given that tax payments in Colombia are done in the second quarter. Despite that fact, we were able to reach very strong cash flow from operation at 34.5 million, and we're able to accomplish about 15 million in free cash flow. CapEx, as we stated in the past, is trending down and is going to be even lower in the second half of the year, given the growth CapEx phase that has already been completed and the amount of excess capacity that we have right now based on those investments. From a balance sheet perspective, the balance sheet has never been cleaner. We're at an all-time low as far as leverage goes, 0.06 times debt to LTM adjusted EBITDA, paid down 30 million year to date, and we'll look to continue redeploying cash in several ways the rest of the year based on what we're projecting for strong cash flow in this second and third quarter. Finally, the backlog was at an all-time high, reaching above $1 billion, up from 917 million in the first quarter. So it was a nice sequential jump that we saw, and the driver of that continues to be our main markets, mainly Florida and the Southeast. Many places throughout Florida continue to do really well, especially kind of like the high-end condo market. So we continue to be very bullish about what the backlog should look like and the book-to-bill going forward. So we'll kind of dig deeper into the backlog on the second slide. If you were to look at this year over year, backlog was up from about 800 million to 1 billion. So it's a nice jump of about 29% year over year. As I was mentioning, the strength in the condo market and in high rise was the main driver of this. Additionally, it was very encouraging to see that the level of orders in the kind of light commercial segment in Q2, in line with what happened in the single-family residential space, was very strong. So we should be able to see nice performance in the commercial segment as well the rest of the year, based on the orders that were taken in the second quarter of this year, and basically based on the backlog of orders that we already know that are taking place for projects that are up and going. Backlog conversion, we've touched on this in the past. It gives us very good visibility as to what's to come for the next typically 18 months to 24 months. So essentially, 25 is already well built up, and pretty soon we're going to start building into 26. A lot of these high-end projects, high-rise towers that we're booking into the backlog are multi-year projects. So that even gives us visibility well into 2026. Single-family residential was a highlight as I mentioned earlier, $96 million for the quarter, up 10% year over year, and became 46% of revenues. Even more so, more impressive is the level of orders that we saw in the second quarter of the year, up 60% versus 2023. So again, the story continues, and we continue to expect a ramp up of revenues on that segment for the rest of the year. What's encouraging also is that, these $96 million didn't really get meaningful contributions from the other geographies where we're expanding via showrooms or the vinyl product that we're launching, which we have said that will be ramping up in the second half of the year. So not only the legacy business is performing well, and the level of orders in Q2 allows us to kind of expect strong performance the rest of the year, but then we also have these avenues for growth in the shape of geographical diversification and the vinyl push into new markets. Next, from a revenues perspective, again, second highest revenue quarter in the year, driven by single-family residential. It was offset by a decrease in multifamily. It was a very tough comp. Q2 of 2023 was the highest quarter in terms of commercial revenues, but as I just stated, we actually saw a nice trend sequentially and expect that to continue the rest of the way based on the level of orders and the timing of the backlog for 2024. From an EBITDA perspective, in line with expectations, it was a nice jump sequentially. Tough comparison again against Q2 of last year. As in the last couple of quarters, we've had a headwind in terms of what FX looks like. The peso has strengthened significantly since Q2 of last year, but more so against Q1 and Q4 of 2022. In other words, that trend is normalizing, and if you look at FX for the last 12 months, it's actually been very stable. So we don't expect that headwind to continue moving forward, and we expect this to be the last quarter in which we had that type of headwind. The other thing that impacted margins in terms of EBITDA goes is the operating leverage that I mentioned, lower revenues, higher salaries, which were adjusted at the beginning of the year. And finally, the revenue mix, which included more single or more product mix as opposed to full windows, right? So we'll see how that looks going forward, but we also expect sequential gross margin improvement the rest of the way based on more operating leverage. From a balance sheet perspective, we touched on this earlier. The level of leverage is as low as it's ever been, and that's essentially driven by what has been a record level of free cash flow and operating cash flow on an LTM basis. We repaid $30 million of debt, as I mentioned. It continues to distribute out dividends to shareholders, which was recently increasing in Q1. So we expect to continue being able to do that based on the projection for continued strong cash flows the rest of the year. Finally, on the outlook, we narrowed the range that was previously provided. We had provided 3 different scenarios. We kind of went back based on the level of visibility that we have today to a more narrow range. And we get a lot of confidence on giving this guidance based on the level of orders that we saw in Q2 and what we expect to translate into invoicing the rest of the way for the year. And based on that, we're expecting revenues now to trend up to $900 million and EBITDA to trend up to $280 million. With that, I thank you for being here with us today and expect to see you in the next call. Thank you very much.